These are my son's books. They're Goosebumps books. He loves Goosebumps. The Scarecrow Walks at Midnight. They Call Me the Night Howler. Ooh! Ghost Beach. Trick or Trap, right? He has like 50 of these books. But the problem is we buy all these books. And he asks me one question all the time. Daddy, can you read it to me? Daddy, can you read it to me? But he never learns how to read it. That's what people do when they ask loan officers, can you read me the loan estimate? Can you read me the fee worksheet? What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership, and tonight we're going to go over closing costs. How to not just understand closing costs, but know what's included in your closing costs. Know what you're paying for, just like my son. What are you paying for, right? Why are we buying all these books when you don't know how to read them? He's young. We are going to work on learning how to read them. So tonight we are going to work on you on understand everything you need to know about closing costs so you can shop your closing costs. If it's your first time tuning in, do me a huge favor. Hit the subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night at 9 p.m. on Facebook and YouTube, and we post content daily on TikTok and Instagram. Also, guys, this is an interactive live stream, so ask a lot of questions, all right? If you have questions about home ownership, if you have some sort of uncertainty, I want you to ask it tonight. We do all our Q&As at the end of our live, so be patient as we go through the live. And if you have questions, I'll answer all your questions at the end. So tonight, we are going over Goosebumps. No, I'm kidding. We're going over closing costs. What are you really paying for, right? You're out there writing offers on house, and you already come in with a big down payment, and all of a sudden, you got costs to pay on top of your down payment. You're like, what are these costs, right? It's not a couple bucks, it's a couple $1,000. So you should definitely know what's included in your closing costs. So you know how to shop closing costs. When you talk to a lender, a lot of them will tell you, hey, I can't provide you a loan estimate. A loan estimate is a receipt or a breakdown of your closing costs. Sometimes they don't want to provide it for you. Sometimes they provide you other types of receipts, or they provide something called a fee worksheet. No matter what they provide you, all closing costs are broken down into 5 categories. Here are the 5 different types of closing costs in your loan estimate, in a fee worksheet, or in a closing cost receipt. There are lender fees, there are miscellaneous fees, there are title fees, escrow, and impounds. So no matter what breakdown you're looking at, they should fall under one of the 5 categories, okay? So understand that. They should all fall under the 5 categories. Let's talk about lender fees first, right? That's the big fee. That's the fee every lender has a different amount, a different quota, right? Or a different cost, right? These are your standard fees. When you're looking at a loan estimate, a fee worksheet, or any type of worksheet, there's typically an origination. If you are doing down payment assistance, there will typically be an origination charge. Since the bank is, whoever is buying the loan that the loan company is originating, probably not getting paid on the back end, so they charge you an origination. So if you do any down payment assistance programs, there will be an origination. So closing costs is higher on down payment assistance. If you do a non-qualified mortgage or a hard money loan, there is typically an origination charge, right? When you're buying a home. If there is an origination charge, sometimes there's a discount point, which means you told the lender you wanted a specific interest rate. And maybe the par rate, which means it doesn't come at a cost, probably is higher than what you wanted. So you tell the lender, I want a specific payment or a specific interest rate, and for them to give that to you, they have to charge you a discount point. Every lender runs their business differently. Every lender has different corporate margin, and with their margin, if they for you to take a specific rate is not enough to cover it, they charge you a discount point, right? So if you get a loan and you see a discount point, tell the lender, hey, can I get a par rate? So it's the best, easiest way to shop, which we'll talk about in a second, is when they give you a par rate. If they give you a rate and they already blended in their discount point or origination, it's really hard to see the true cost. All right. So definitely there's an origination, there's a discount, right? Origination is something they charge up front because that's how they run their company, right? That's how, because other lenders or the bank, whoever they're selling the loan to, is not paying them on the back end. And then there's a discount, means you wanted a specific rate, a specific payment. And here's a standard fee: underwriting charges, right? No matter what lender you use, there will be an underwriting charge. If a company says, hey, we're not charging you any lender fees, they probably charge you the underwriting charge, and then they took a higher rate and they covered it for you. Okay, so there's an underwriting charge. Also, there's processing. If you get a loan through a bank or through a direct lender, they charge the processing and the lender fees. If you are getting a loan through a mortgage broker, they charge the processing fees in miscellaneous because it's a third-party company who's processing the deal. Another fee you'll see sometimes is a loan commitment. I don't understand why they would charge you a commitment, because you've already committed to make a monthly mortgage payment for 30 years, right? For every month for 30 years. But you'll see the loan commitments from the big banks. I'm not going to say their name because I don't want to bash them, but you know the banks you can go through and make a deposit. They typically will have a loan commitment, right? Or you go through a credit union. They'll have not all, but a lot will have these loan commitments. It's more with these bigger banks, these brick and mortars. You'll see a loan commitment, right? Another thing you'll see on lender fees: rate lock. If you want to lock in a rate and it's on a refinance, on a purchase, if you're in escrow, they charge you a rate lock fee, right? Sometimes when you're buying a home and the home is not being built yet, right, they charge you a rate lock. Also, there can be an application fee. That's pretty rare, but I do still see them out there. So if you see an application fee, it falls under lender fee, right? Like I said, the bigger banks, they'll charge an application, or these small direct lenders sometimes, they give you super low rates, right? If you see the rates so super low, you'll see these application fees, you'll see these loan commitments, right? When you start seeing that they give you these low rates, they're making up for it by charging you in the lender fees. And last but not least, if you are buying new construction, there's a float down. That's very standard. So if you want to lock in your loan within 6 months or 90 days, depending on when the house is going to be done, some of these new construction lenders will charge you a float down, which means you can lock your rate, and if rates improve, you can change the lock one time. But they either charge the fee up front or they put it in the interest rate. It's higher than your typical interest rate by like 1/8 of a point, or they charge you a fee up front. Remember, a lot of times you buy new construction, the builder is paying your closing costs. So rate lock fee might not be so bad, all right? But those are your standard 8 lender fees. There might be other ones that pop up, but typically they should fall under the 8, okay? So that right there is the first category of your closing costs, your lender fees, all right? The second category, your miscellaneous. Why are they called miscellaneous? Well, every company has different process of collecting data, different process of verifying your information. And when they verify, they use third-party companies. These miscellaneous fees aren't from the lender. They're being charged to a lender by a third-party company to validate your information, right? And they can't increase the dollar amount. So for example, if your appraisal costs $500, they can't charge you $600. They have to charge you only $500, right? The home warranty. If you decide to get a home warranty, right, this is optional. The whole home warranty would show up in there. The flood cert, the notary, the wire, the recording, the home inspection, credit report, right? If your credit report's $80, they can't charge you $80.50. They only can charge you the $80, right? Termite inspection, which is optional. Endorsement, sub escrow. You'll see some of these sometimes in the escrow fees, right? Which we'll go over in a second. But typically they'll either put them in the miscellaneous or escrow. And we'll go over that in a second. HOA questionnaire. If you buy a home and you're buying a condo, sometimes the lender has to order a questionnaire and they charge that to you, right? Let's say the questionnaire is $200. They have to send it to the HOA. They got to charge it back to you, right? But remember, they cannot increase the cost. And of course, the last two fees, right? Even though you finance the upfront mortgage insurance on an FHA loan, the cost has to go there. Sometimes I see people go crazy. Oh my God, the lender's charging me $20,000, $10,000, $15,000. Relax. It's really hard to get away with the crazy charges. Not say it's impossible, but it'll probably be the upfront mortgage insurance or the VA funding fee. If you don't have a Purple Heart and you don't have more than 10% disability, there could be a VA funding fee, all right? And that will be in the miscellaneous section. Remember, It's not the lender's charge. It's for FHA or it's for VA. Okay. So remember, those are miscellaneous. You'll see that, right? You're like, I don't understand this. Is this miscellaneous? If it's a lender fee, but it's not the standard 8 fees I told you, it's a third-party fee, and it's called miscellaneous. The third category of closing costs, title insurance. When you buy a home, there will be title insurance. There's 2 types of policies when you get title insurance, okay? There's 2 types of policies when you get title insurance. There's the owner policy, right? Which means when you buy a home, the seller pays for you, the owner's policy, and it's based on the purchase price. And that policy is there to protect you, that when you buy the house, there is no other liens on the property, that they did a title search to make sure there is no lien. So when you buy it, it's encumbrance free. That means you shouldn't have a lien on it. Doesn't mean when you buy it, things you do can't put liens on it. That means when you buy it from that seller, whatever liens are on it, right, before the title is transferred to you, they're going to take care of it if it popped up, right? And if for some reason it popped up afterwards, that insurance guarantees that they're going to take care of it, all right? 5K, we'll answer that second question in a second, Gretchen. And then there's a lender policy. If you are financing a home, there will be a lender's policy, and that's what you buy for the lender. Same thing. You're protecting the lender for any other liens on the property. And that title is based on the loan amount, right? Because it's based on the loan amount because that's what you're financing. So that right there is the third category of closing costs, right? Your title insurance. The fourth category of closing costs, what you'll see is escrow, right? Escrow is like a referee, a third party, a lawyer, right? Now, it's not saying it's a lawyer, only on the East Coast, right? On the wet states, okay? But escrow is a lawyer or a mediator. They make sure seller does their job, buyer does their job, lender does their job, and title does their job before they let you guys commune and money's transferred and titles transferred, deeds are transferred, right? You pay a third party to make sure everyone stays honest. And there's 2 sides of it. There's the seller and there's the buyer, right? The seller's going to pay their portion of escrow, and the buyer, which is yourself, are going to pay the buyer's of escrow, right? Buyer's costs. If you do a refinance, there's only going to be the consumer's escrow, okay? Typically, escrow is about $2 and $2.50 per thousand. So it's based on, sellers is going to be based on purchase price. Buyers going to be based on loan amount. And typically you'll see other junk fees in there too, about $200 to $500, sometimes $700. On refis, they're a little bit cheaper, okay? Typically an escrow will have a flat fee for a purchase and then little junk fees. And we'll go over that in a second, you'll see, okay? So that's the fourth category of closing costs. And now what?
Just so you know, you should let everyone know on stream that if there's a delay,
yeah,
sorry, we can't fix it right now since we're live.
If there's a delay, we can't fix it right now because we're live. I do apologize, okay? The fifth category of closing costs are your prepaids. When you buy a home, there are prepaids. And this is where people get hustled all the time, right? I lose loans to people all the time because they use this shady style like, all your closing costs are covered. We're going to cover all your lender costs. It's more than lender costs. There's after lender costs, typically when they say they're going to cover lender costs, they're going to cover the lender costs and miscellaneous. You still have title, you still have escrow, and definitely you have your prepaids. Sometimes they'll cover title, right? They won't. No, sometimes they'll cover lender fee, miscellaneous, title, escrow, but they won't cover your prepaids because your prepaids are definitely your costs. It's your taxes, your hazard insurance. Yes, there are times when they do cover your prepaids, but typically they're your taxes. It's your insurance. It's your interest that you're moving in, right? When you're talking about prepaids, there's 3 types of prepaids. There's your hazard insurance, there's your property taxes, and your daily interest. And how hazard insurance is done, it's you pay up 1 year up front for your hazard insurance, and then there's a 2-month reserve they collect, right? And then when you make your mortgage payments, if you have impounds, you pay every month, and the servicer will pay your hazard insurance. Property taxes, it's the purchase price times it by your tax rate. If you don't know your tax rate, industry normally uses 1.25%, but it could be 1%. But if you are buying in another state, like the state of Texas, where there's no state taxes, the impounds, your tax rate could be 2.5%. Okay, so it's your purchase price times your tax rate divided by 12, And depending on the months you're in, and we'll go over that in a second, right? That's how they calculate. And of course, your daily interest. It's whatever your interest rate is, times it by your loan amount, divided by 365, and you times it by how many days left you have in the month to fund. If you fund on the 25th, there's 5 to 6 days left. You fund on the 5th, there's 25 to 26 days left. If you fund on the 30th, there's no days or 1 day left, depending on when you fund. It's like prorating rent, okay? Let's go with a breakdown here. Let's go over your hazard insurance. Here's a breakdown example for you. So when it comes to your hazard insurance, right, it's going to be your purchase price times it by your interest rate. No, not interest, sorry. It's your purchase price times it by either 0.15 or 0.20. 0.15 is typically your hazard insurance. 0.20 is your homeowner's insurance, which includes hazard insurance, right? That's if you get the Ferrari version of homeowner's insurance. If you have a quote already, you can go off your quote. But if you don't have a quote, this is how they estimate it when they're building out your closing costs, right? As an estimate. It's your purchase price times by 1.15 or 0.20 will give you an amount. That's your yearly premium. Of course, you divide it by 12, right? Because that's your monthly. And that monthly also goes against your DTI. You take your monthly times it by 14. Like I said, look at your impounds. They typically collect 1 year up front, which is 12 months, and plus 2 more months, which is 14. So you'll know they collect about 14 months. And you'll see that on your loan estimate or your fee worksheet, right? You're like, hey, I don't see my impounds anywhere. If they don't do it, that means they don't want, because in their mind, this is how they justify it. Well, those are your fees. These aren't closing cost fees. Impounds, if you got to come out of pocket on top of your down payment, it is a fee. I don't care if it's your impounds or not. It is a fee, okay? Now let's look at your property taxes, right? So people ask me all the time, when is the best time to close? So you fund July or August, 6 months. You close in October, December, 10 months. Those will collect 4 months more, okay? It's important for you to know that because a lot of lenders, they do that hustle, but they do that hustle where let's say you close in December, but they give you 3 months. They give you 6 months, right? And all of a sudden you're in escrow and they're like, whoa, and it's not my fault. This is what they're collecting. A lot of lenders use that boo-boo excuse, right? I'm letting you know all the tricks because a lot of lenders will give you low impounds just when you're shopping for a loan. Oh, see, this guy's closing cost is a lot cheaper. Of course, because they give you 3 months when it's 10 months, okay? And of course, it's not something you can blame them on. It's like, oh, that's what the county's collecting, okay? So here's an example. Purchase price times your tax rate. Here's 1 1/4, which is divided by 12. It's $416 on this $400,000 purchase, right? You fund between June and August at 6 months. That's $24.96. If you fund October to December, it's 10 months, $41.60, right? So it's almost $2,000 more. Well, that means I should wait to buy October, December. Well, if you wait 6 months, prices can go up. So you might have less impounds, but the purchase price might go up or interest rates might go up. Don't judge it by, oh, I'm going to buy here because it's cheaper, right? Prices can be up, rates can be up. You should know this so you know how to prepare for closing costs, right? Your taxes are paid twice a year, once in November and the second in April, right? But it's late after February. So remember those things, right? That's why they collect impounds to pay your taxes, okay? And the third part of your impounds are your daily interests. So it's your purchase price times it by your interest rate. And of course, there's 365 days a year. I wish they only did weekdays, right? But they don't. They charge you interest on the weekend too. So on this purchase price, 400 times 3.5, which is your interest rate or whatever your interest rate is, divided by 365. That's $38.36 a day. And then just times it by the day you fund. Well, the numbers keep changing. Of course, if they are giving you an estimate, they might do 15 days. That means you have either 15 or 16 days of interest left, depending on what month you fund into, right? But let's say you fund on the 25th. Even though your loan estimate says a higher number, when they balance out the final HUD or final receipt or your closing disclosure, the number will shrink, right? So it's better to overestimate than underestimate, right? So typically people do 15 days. You fund into the third, there's 27 or 28 days of interest left. So depending on your fund, okay? So that right there are your 5 categories of closing costs. So before you read a loan estimate, a fee worksheet, or any closing cost receipt, all your fees should fall into the 5 categories, right? Lender fees, miscellaneous fees, right? Title fees, escrow fees, or your prepaids. Okay, so that's what's included in your closing costs on top of your down payment. And typically closing costs right here, if your purchase price is under 350, closing costs is about 3%. And when it's over 350, it's between 2 to 2.5. Why is that? Because there's these flat fees, right? For example, when you buy a home, let's say the lender fees are 2,000. Of course, on a $300,000 purchase, that's almost 1%. Okay, if you buy a home for 700 grand, right, $2,000 is not even, it's barely anything. So of course, the smaller the purchase price, these flat fees, like I said, escrow earlier has a $500 flat fee. $500 on 300,000 at is a lot. That makes the percentage higher than on a million, right? So it all depends. So typically, the rule of thumb under 350, 3%, over 350, 2 to 2.5. Unless, like I said, you're doing down payment assistance, you want to add another 1.5 to 2%. So if closing cost is 3, it would probably be 5%, right? If it was under 350, okay. Unless also if you're doing what do you call it? I'm going blank right now. If you're doing a non-qualified mortgage or you're doing a hard money loan, it could be 2 or 3%. Typically, non-qualified mortgage 2%. When you do hard money, about 3 to 4% in origination charges. Okay, remember that when you are trying to figure out your closing costs. Here's a breakdown. Right, I broke down a loan estimate for you. So when you're looking at a loan estimate, it's broken down to 3 pages. Page 1 is a summary. Page 2 is a breakdown, and page 3 is your overall cost, right? So you want to focus on page 2. And I broke it down, and that's the reason why I did the closing costs in the 5 categories, right? Section A, page 2, section A is your lender fees. Page 2, section B and E is your miscellaneous, right? That's where your lender's miscellaneous and also title's miscellaneous, their recording fee, transfer taxes. Sometimes you'll see it bleed over in section C if it's an escrow, miscellaneous, or junk fee, right? But section C will be your title and escrow fees, right? Section F and G is your prepaid, right? So you'll see that in your closing costs. When you get a loan estimate, sometimes some lenders will give you a loan estimate. You will see the breakdown like this. Sometimes you will see a fee worksheet, right? You got to break it down yourself, or you can always reach out to us, right? 714-790-9697. If you have a loan estimate or a fee worksheet or some receipt, you want us to help you read it and beat it, right? Beat it. Then go ahead and send it over, right? info@what'samortgage, right? Send over the loan estimate with your phone number and contact and your email, and we'll reach out to you. We'll help you read it, but also help you beat it. Lately, things have been kind of tight. We've only beaten a handful of them. There are people out there that are being really competitive right now, but that we are beating, let's say out of 10, we'll beat out like 4 to 5, right? Before we were beating out like 8, right? But I see banks, I think, are nervous about losing business. They're backing off on their rates. So typically we were winning about 8 of them, say 4 to 5 this time, but we're able to help the other 5 have confidence and know with certainty that they're not being overcharged. Remember, closing costs can be a big deal, right? It can save you. You can buy a washer and dryer. You can get a new TV. You can paint the house. You should understand what's included in your closing costs so you know next on how to shop your fees. Guys, if this information is valuable, do me a huge favor. Save this video, share this video, and like this video. You have any questions on closing costs, leave a comment below and we'll answer it after our second session. Also, by now, if you're not following us, please hit the subscribe or notification button. But now you know what's included in your closing costs, right? I am going to do another video on how to read a loan estimate, but tonight you don't even need to know how to read a loan estimate to shop for a mortgage. I'm going to make it simple for you, right? Tonight, we're going to show you the 5 steps to shop for a mortgage, all right? So if you follow these 5 steps, I promise you, it will be easy to shop for closing costs, right? You don't need everyone and their mom running your credit. All these people lining up, I want to run a credit. I want to run a credit. Tonight, the 5 steps, I don't care if you're buying or refinancing. You follow these 5 steps, right? You will be able to shop for closing costs. Okay? This is step 1. to shop for closing costs. A mortgage lender must run your credit. If a mortgage lender doesn't run your credit, you ain't shopping, right? We don't have that bleep option yet, but you ain't shopping, right? Because if a lender doesn't run it, you don't have a real number. I hate it. My biggest pet peeve. Oh, this app told me this, right? This such and such told me this, right? Credit Karma, all in one, they told me this. Remember, a mortgage credit report. You need a mortgage credit score to shop. When you run your credit to buy a home, they run FICO score 2, 4, and 5. You need that credit scoring model to shop for a home, not Vantage score 3 from Credit Karma or FICO score 8 from your Chase app. You know, most people, if you go, most companies that you use to run credit uses FICO score 8, right? Car companies use auto FICO score. You need a mortgage one. I keep reminding you guys because I see a lot of people reach out to me and they give me a score and I'm like, all right, cool. But then I'm like, where'd you pull it from? And then I'm like, oh, right? So you need your credit pulled by a lender. I got a little dramatic about it because it happens so often. Your credit report is good for 90 to 120 days. If you go out and shop for a loan and the credit report is over 120 days, that score is not accurate. They're going to have to run it again. And the lender will use your middle credit score. Yes, Fannie Mae just released a rule that they're going to blend your credit together when there's multiple people, right? They're only doing that for qualifying purposes only. But when they are trying to give you an interest rate or give you a private mortgage insurance rate, right? They're going to use your middle score. If there's multiple people on the loan, they're going to take the lowest middle score, okay? So you need your credit scores, and make sure when a lender talks to you, you know your middle score. Don't blend them, just the middle score. Step 2, create your profile. Once you talk to the first lender, you will know how to create your profile. You need to know your middle credit score, the purchase price on a refinance, the appraised value, the loan amount, okay? Is it a purchase or refinance? On a refi, is it a streamline, a cash out, a rate and term, right? Is a property owner occupied, a second home, or is it an investment, right? The property type, is it a single family home, duplex, triplex, fourplex, or manufactured home, right? Or condo. It cannot be a mobile home. You cannot get a traditional mortgage. And the loan program, is it an FHA? Is it a VA? Is it conventional? USDA, okay? It also can be a jumbo loan. It can also be a non-QM loan, right? But typically people don't shop non-QM and jumbo too much because they're portfolio programs, right? So, but your standard loans are going to shop as FHA, conventional, VA, USDA, all right? The reason why you want to know your profile, it tells the other lenders you mean business. And the fact that you generated a profile and you know your middle score, they know you're a shopper. It's just like if I know someone's a shopper, I'm going to be, I'm either going to not give them my time or day because they're just going to shop me, right? That's number one. Or number two, that means why would you want to work with someone who doesn't even want to put effort into you, right? Or number two, right? They're going to be very cautious. They're going to give you a good deal, or they're going to ask you, what did the other lender give you, right? And you can tell them or not tell them. It's up to you. Okay. And then, of course, once you know that, we have our profile sheet here. You can download this at our whatsamortgage.com in our Ultimate Mortgage Guide. We let a lot of our PDFs. They're all in our Ultimate Mortgage Guide. Don't forget to go to whatsamortgage.com and download our Ultimate Mortgage Guide. And then, of course, you want to compare interest rate. You want to compare the principal and interest. So you want to look at the loan estimate, right? If they provide you one, you want to know the interest rate. Look at the principal and interest payment. Right? Look at the mortgage insurance, especially from conventional loans. Conventional, you can shop mortgage insurance, or lenders can. Lender fee section A, section B, and the lender credit is section J. So when you talk to a lender, you want to write all that down so you can compare, right? Which is step 3. Once you generate your profile, you want to talk to 2 to 3 different lenders. I put 4 on there just for some of you guys who are avid shoppers, right? You want to shop everybody on the same day. That's when rates are accurate. You don't want to shop everybody and you shop someone else another day and pricing's on another day, right? You want to shop everyone the same day, even though rates can change by the minute, but it's going to be pretty close if you shop on the same day, okay? Once all the lenders give you their closing costs, their loan estimate, their fee worksheet, right? You go back to your profile and then you write all the numbers down, right? Once you write all the numbers down, you want to compare fees. Step 4, you want to compare the loan estimate, section A, section B, and section J. All the other sections, the lender has no control of, right? They have no control of title, no control of escrow, no control of impounds, right? No control depending on when you fund, all right? Daily interest might change a little bit. It's not going to be like that much. But when you're comparing, you want to shop section A, B, and J. That's what you want to pay attention to, right? Not all loan officers provide loan estimates, but you could always ask, right? If you don't, you need to group them either in the loan origination side, right? Section A, section B, or section J. Lender fees, miscellaneous, or lender credit, right? Once you do all that, then you can compare the fees, okay? So number 1 is important. A lender must run your credit. It's good for 90 to 120 days. 2, generate your profile. Give the lender the middle credit score from when the first lender ran your credit. You don't need a bunch of people running your credit. I'm telling you guys again, I'm telling you right now, some lenders will say, well, your credit, it won't affect your credit. The CFPB says that you can run your credit as many times as you want within 45 days. Some people say a 2-week window, and it won't bring down your credit score. Phooey on them. Every time your credit is ran, it's a hard credit pull, which will bring down your credit. Of course, if you've got some 780, 790, 760, 740, really not going to affect you too much. But when you're sitting in that 680 to 620, you want to tread lightly, or 660 and under, tread lightly with your credit being ran by multiple people, right? I'm not saying you can't run it more than once, but tread lightly. Every time someone runs it, it does affect your credit, all right? So that's step 4. Here's step 5. I don't know why no one else thinks of this, but of course, I thought of this. Step 5, you go with the lender that gives you the best deal. If that lender has the best deal and you can go with them, right? If they run your credit and your FICO did not drop, go with the best deal. Or take the best deal, bring it to the loan officer you like the most. If it's your original one that ran your credit and you don't want to mess your credit score, bring them that loan estimate. Or go with the loan officer who pretty much gave you the best deal, or no, who you like the most, all right? Go with the one that likes you the most, right? Take the best deal to the one that likes you the most, or bring it back. And if your FICO does drop, whoever runs your credit, bring it back to the original lender. They'll either match the best deal, or they'll be close to it. At least your FICO did not drop, all right? Hopefully that helps you out. So that right there are the 5 steps to shopping for a home. Remember, check your rates during the weekdays, right? Before 3 p.m. Check all lenders on the same day, okay? So that is my tip to you. Shop during the weekday. When you're talking to lenders, don't talk to lenders on the weekends because rates, they change on the weekday. So talk to lenders on the weekday before 3 p.m. That is my tip to you, okay? During the weekday, before 3 p.m., and check all lenders on the same day if you want an accurate quote. And that right there is how you shop for the best deal. I don't care if it's a purchase. I don't care if it's a refinance. That's how you shop for the best deal. One lender runs it. Generate that profile, right? Talk to a couple of different lenders, right? Compare and take the best deal and see who you want to go with, right? And that's who you should go with. And that's how you shop for a mortgage. Guys, if this video brings you value, because I'm saving you a lot of money here, guys. If this video brought you value, save this video, share this video, and like this video. If you're not following us by now, please hit the subscribe and notification button. Well, let's go some Q&A. I think there's some restreaming problems, so we cannot do Q&A today.
You can read the comments.
Okay. Let me see. I'll read some of the comments. So there is a audio delay. I am sorry. Okay. Okay. You can see this whole live stream on YouTube at the end of the week if you want to see this whole thing over again without the delays. Gretchen, what's going on? Is $5K too much to buy interest rate down 1 point? Um, if I typically would not buy down a rate on my first mortgage, you would need to keep this loan for more than 5 years. All right. The average person keeps their first loan for about 2 to 3, maybe 4 years, if that. But if you tell me right now you plan on keeping this mortgage, it ain't that bad buying 5K. All right. It takes you about 5 to 7 years to recover. All right. Hopefully that helped you out. Gary Hidalgo, thank you so much for your kind words. Gretchen, hopefully that helps out. Negative closing costs. I got my refinance. You got negative closing costs. That's great, which means they gave you a higher rate to cover all your closing costs. Might not believe that, but these costs come to the bank, and they got to pay for them one way or the other. Typically, you take a higher rate, and they'll cover your closing costs. Hopefully that helps you out. Camp, thank you so much. You're welcome. Claire, hello. Is there an upside or downside to non-warrantable condo for first investment property? Well, a condo, right? Warrantable, non-warrantable. As long as it rents positive, you're fine. That's all that matters. You got to look at the cash flow. It's going to be a problem selling it in the future if it stays non-warrantable, because then that means you need someone to buy it with a non-warrantable loan as well. But if you're going to keep it for cash flow, as long as it makes sense, then it makes dollars, then you're okay. Hopefully that helps you out. See here. You're welcome. Thank you. Can you explain the point system? So Danny J Dabs, right? So the point system. Can I pull up something in a sec? All right, give me 1 second, Danny. I'm gonna pull it. What? Yeah, don't log in yet, guys. I'm gonna show you how to read the point system right now. Okay. Give me 1 second here. I don't want to show the logins on it because I don't want them to know. I don't want them to get the company to be upset with me that I logged into it. If that makes sense.
Pull it up.
Let me log in really quick, guys. I'm gonna log in. Give me a second here. Show you guys how to read a rate sheet. Okay. I guess there was a reprice today. Let me show you how to read a. Let me see if I can bring up a rate sheet here. All right. Here you go. Show that one. So Danny, rates change by the day. And when you buy down rates, you don't buy down like 1 point, 2 point, 3 point, right? It all depends. So let's say typically a company wants to make at least 2%, right? They don't make 2%, they're not covering their bills or their fees, right? Let's go into this really quick here. Let me zoom up really quick here. Right? Let's go with this FHA loan, okay? Back it out a little bit here. See? So typically right here, you will see, let's say on an FHA loan, when you see this 15-day lock, 30-day lock, these are the interest rates right here, right? This is the interest rate right here. This is how much they pay the bank. So if they sell you a 1.99, it comes at a cost of them for 1.5%. But remember, they're not making any money. So if they sold you a 1.99 on an FHA 15-year fix, remember, they need 2% to make a profit. So they would have to sell you this rate at 3.53%. Okay? So, dude, that's like the real deal right here, man. I don't know anyone's giving it to you guys that way. So typically, if they want to make 2%, they're going to sell you 2.625 right here, but they're going to charge you the difference to get the 2%. All right? If banks got to make 2%, if you took 2.625, hold on, 2% minus 1.888, they would have to charge you 0.112 to get 6%. I mean, to get their 2%. So if they sold you 2.75, they make their 2% and you get a credit. They sold you 2.875, they make 2%, you're getting credit at 0.49. They sold you 3%, They make 2%, 0.917 goes towards your closing costs. See, the higher you go up, the more closing costs. Let's say you took an FHA 3.25. They make 2% and they credit you 2.249 towards closing costs. This is on an FHA loan, and this is today's pricing. All right. So it is important that you understand that it's really hard to decide, right? Let's say it costs you 1% to get that rate, right? Because they need to make their 2%, whatever it is, right? That you want that rate, it costs you 1%. So if it's a $400,000 loan amount, they charge you $4,000. If you're buying the rate down so low where it costs you 2 points, that $400,000 loan amount might cost you $8,000, right? That's how it works, depending on the rate you take, right? Depending on what it costs them to get the rate, then they charge it to you after they make their 2%. Of course, when you go with the bigger banks, right? And I'll go to that in another video, right? You go with like the loan depots, the guarantee rate, the movement mortgage, right? When you deal with their loan officers who generate their own book of business, right? Their rates, they got to make more than 2%. If you go with their direct lines, which means like when you call in on their hotline, they make less. So the rates are lower because they're paying that loan officer a couple $100. What about $625,000? Like I said, it's more than just interest, your purchase price. It's your down payment percentage, your credit score, property type. If you want that answer, Danny, you can go ahead and message me at info@whatsamortgage.com or definitely text us at 714-790-9697 and we will help you out. All right, guys, hopefully this information was valuable. And thank everybody who watched. I do apologize about the glitch. We want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you so much. And for everyone who stuck it out even during the glitch.